I've thought about pulling the trigger and owning myself a petrol station with a tenant such as Caltex or BP, but I've chickened out. And the reason I've chickened out is I am not sure of the future of petrol stations. I don't know what will happen with electric cars. Welcome to the Urban Property Investor. I'm your host, Sam Saggers, here to help you crack the code of real estate wealth. Today's show, code cracking stuff. We're going to dig into the commercial property market. It's all a buzz in the commercial scene. So let's dig into what is going on in the world of commercial real estate. We never know if the show is going to be worthwhile till we get to the end. We never know if what I'm sharing is going to be golden nuggets or actual just hog's wallop. But hey, who knows? Let's do it. Let's give the show a go. I've recently bought some commercial property and I want to talk to you about it. I want to give you some insights. I want to share what I'm up to, and hopefully there's some good insights for you to master this game, which is property investment. But hey, welcome back, regulars. Play the program in double speed. You know the drill. And of course, all the episodes I've done are actually lessons on real estate. So feel free to go back in time. Once again, a shameless plug for my new book, which is called The Australian Property Game. Now, I'll tell you what, there's a little bit of sun speckling through the window. I'm going to probably be told that my podcast sucks because the sun is coming through and people on YouTube will complain. So if you're a YouTube watcher, you're a rare beast because I think 40 people watch on YouTube. Thank you for watching on YouTube. I'm not sure why you watch on YouTube, but who knows? I don't know. But I listen to my podcasts on Spotify, and I listen to other podcasts on Spotify. And really a big part of my job is just simply sharing information and talking property. But today I want to talk about building a portfolio, and ultimately there is a concept known as modern portfolio theory, and you can see the sun in my eyes. Now, I don't know if I should stop the podcast or actually try and go and fix the sun coming through that window. Let's see if I can fix the sun. Give me 1 sec. Let's see. Is that going to do it? That could do it. I could have fixed it. I could be fine. We don't have to stop the show. Oh, no, there it is again. The sun's coming through the window. It's shining on my head. Let's try a new angle. Does that angle, that gets me out of the sun? I'm going to go for it. I'm going to not conclude the program, but I'm going to talk to you on a strange little angle that may save the show. Can we save the show and not have a glowing head? So if you're listening on Spotify, you've probably hung up by now, but hey, I'm going to keep going. I'm going to hide in the corner so the sunbeam does not affect my face. All right, let's do it. Geez, what an opening that has been. That has been tough work. But hey, I want to talk about commercial property. I recently bought some commercial property. I've done it many times over my journey as a property investor. But when it comes to, I guess, building a portfolio, there is a place for commercial real estate. And really, when I look at the concept of building a portfolio, really there is the concept of some very safe and secure ways to go around buying real estate, some very vanilla pieces of real estate, which, as the phrase goes, as safe as houses, really won't offer you a high return from a cash flow point of view, but will be very, very low risk. Now, Harry Markowitz came up with the concept of modern portfolio theory, which is just the theory that you want to diversify your investments and you want different levels of risk across a platform. On one side of a portfolio, you want very low risk assets. On an alternative side of a portfolio, you want a little bit more aggressive assets. And really, by having low risk assets and higher risk assets blended together, you get a blended return which is superior in the marketplace. So modern portfolio theory is something that I've studied for a long time, and it's how I build my portfolio. I often call it a bit of a trifecta. You want certain asset types inside of your real estate portfolio that will grow at different levels. Now, the first real property that I think works inside a modern property portfolio is what I would call A-grade real estate, or even what I sometimes refer to as trophy real estate. That real estate which is, it's pretty special. It's pretty scarce. There's only so much of it floating around in this world. It's in typically blue chip suburbs that, once you're in, there is no real ceiling as to what property values can reach. They can just continue to perform decade after decade. Trophy real estate is something that I think a lot of people need in their property portfolio, as is the right housing PPR strategy, the right principal place of residence strategy. Though we often don't refer to our PPR as an investment, it really is an investment for a lot of people. And I think by having the right PPOR or PPR in the right place is going to balance out your property investment journey. Of course, having a principal place of residence is an important tool because it is capital gains tax free. Because it's capital gains tax free, it means you can upgrade your wealth by buying a property, holding it for several years, and selling it. So inside a modern property portfolio, we want to have the right principal place of residence strategy. We want the right trophy real estate scarcity strategy. Then you want what I refer to as all-weather middle-tier investments, all-weather middle-tier investments. Now, these are your quintessential safe property investments. They are properties in good condition. They are properties at a middle range price. They could be 500,000, 600,000, 700,000, 800,000. They're just simply good little performers, and on the risk spectrum, they are low risk. Your trophy real estate in your gun suburb is low risk. Your principal place of residence, typically if it's the right PPOR, it's low risk. And your all-weather middle tier investments are low risk. Now, middle tier investments won't grow as fast as trophy investments. They will have a lower rate of growth, but they also have a lower purchase price. Now, remember, across modern portfolio theory, we're trying to create a portfolio which has different rates of growth, but blended so that we can do well from a period of time, i.e. we can only afford one trophy, but we might be able to afford 3 other middle tier all-weather investments. And why I call them all-weather investments is really they're designed around going through good and bad times in the economy. And they really are the first properties to appeal to the rental market. And when the market goes, they are the ones which grow the best. But they are just entry-level pricing across Australia. So that's kind of our growth strategy, if you like. Then we need a cash flow strategy, which is going to prop up how much income we can create across our portfolio. And really, I use 3 models to create cash flow out of real estate. The first one is to be involved in joint ventures and really add value to real estate through changing its development status. I am all in on buying blocks of land, which I can basically subdivide and sell off the land. And because today to buy a block of 20 properties that you can turn into 20 blocks of land costs a lot of money, I simply team up with other investors and we go out and we buy basically large parcels of land, get a development application on them, and turn them into other smaller blocks of land that have individual titles. We take one title and we turn it into 20 titles or 30 titles or 12 titles. And really what that does is over a 2-year period of time, we can put some money in and we can pull that money out quite quickly. It's a little bit more risk, a lot more risk than buying an all-weather middle-tier investment or a principal place of residence because the development might not work out. But when it does work out, the cash flow that you get for putting your money in can be really good. It can be like 20% per annum over a 2-year period, just putting $100,000 or $200,000 or $500,000 into a deal and pulling that money back out, plus obviously the dividend for funding the development. So that's the extreme end of risk. The lowest end of risk is really your principal place of residence. In the middle, you've got trophy real estate and you've got all-weather middle-tier investments. Then from a cash flow perspective, there is the idea of using a mixed use strategy. And I love 2 mixed use strategies. The first one is the right Airbnb investment, where effectively you're changing the use of how a property is used from a rental perspective. You are not collecting 1 week's rent over 52 weeks, you're renting the property out daily. And for the right Airbnb strategy, real estate can absolutely dividend quite high. You can effectively turn a weekly rent of, say, $40,000 a year into $60,000 a year after all of your costs by using the shared economy platforms like Airbnb. The beautiful thing about the right property which suits Airbnb, and today there is a lot of restrictions and a lot of taxes and a lot of moving parts to that space. So again, the risk profile is a lot higher, but if you get it right, the returns are pretty good. They're pretty incredible. But what else I like about the right Airbnb strategy is you can quite often get a second residency, a place you can go and basically stay, which you own. And of course, quite often as a property investor, we buy investments that we never get to use. Sometimes they're beautiful investments, and really the only beneficiary of use is the tenant using the property. And the other kind of mixed use real estate that I like is the right commercial property. And today on this show, I want to sort of dig into commercial as part of our modern portfolio theory. If we put the right commercial property into our portfolio, we're going to get a high yield and, of course, capital growth. And the yields in commercial are very much superior than really the residential real estate marketplace. The commercial yields can be pretty spectacular, meaning you don't really put any money into the real estate from your back pocket, and you get paid thousands of dollars a year to own the real estate. You go into what we refer to as a positive cash flow dynamic. Now, remember, in real estate investments, there's negative cash flow. The right scarce trophy real estate is going to be very negative cash flow. The reason it's going to be negative cash flow, it might cost $1.7 million, but rent for $1,200 a week. That's going to mean you're going to burn money out of your back pocket. However, that right trophy blue chip real estate is going to grow exponentially. Conversely, the right commercial real estate will actually pay you money from the tenant from day one, meaning you're putting money into your back pocket. But the right commercial real estate is also a conversation piece, because commercial carries a little bit more risk than does residential. So today I thought, let's explore the modern portfolio that I just described and stop and not talk about Airbnb and not talk about all-weather investments, nor joint ventures and syndications, nor a principal place of residence strategy or a trophy real estate strategy. Let's stop at commercial and have the commercial real estate conversation. So I don't know if you're still here. Hopefully you're still here. The sunbeam has now left. I can probably return to my usual position in my chair. And after that long-winded explanation, we're already 16 minutes into the show and we haven't even talked about commercial. But really, when you think about commercial real estate, it's a great way to build wealth. And a lot of really wealthy people end up owning vast amounts of commercial real estate across the country. And when you think about, I guess, just even playing the game of real estate, if you think about like Monopoly, you start out buying houses and you get one house and then you put 2 or 3 or 4 houses onto the Monopoly board. And then after that, you have to elevate into a hotel, and effectively a hotel is a commercial asset. So to win Monopoly, you end up getting the most superior cash flow from hotels or commercial. So commercial real estate is a great way to build wealth, but I will caveat that if you're starting out as a property investor, you may not want to jump into commercial property because it is a big leap of faith. And on that risk spectrum, it's on the higher risk zone than just buying a nice little house to own a well-built house in a nice suburb. But as you build more wealth, build a bigger portfolio, have more opportunities, you definitely need to consider the right commercial strategy. Now, commercial is obviously a few variables. It's not just the idea of one concept. There's a few different concepts in commercial. You've got the commercial office market. Now, the commercial office market is probably the one piece of commercial I would not recommend. If you were buying a strata commercial office in a high-rise tower today, you're probably not going to end up in a place you want to end up. The reason being is the big work from home movement has kind of killed the CBD office market. And the office market, which is relevant in the CBD, is generally owned by big business. Now, it's interesting if you follow some of the tax rulings around, ESG, which is environmental, social kind of governance. Big companies with effectively over 100 team members need to today report on their ESG output. They have to report on effectively what they're doing to lessen climate change to the Australian Tax Office. So, of course, Australia is made up primarily of small businesses, but big businesses, they will rent the right large-scale office commercial property. They will own it. They will buy the right large-scale commercial office building. And a lot of it is to do with the fact that they need to rent or own 6 and 7 star energy efficient buildings. So here in Sydney, what happened recently, Barangaroo created, which is a place in Sydney, these beautiful modern buildings, and all the banks that had previously been renting and owning much older buildings throughout Martin Place and up to Town Hall effectively had to relocate their offices down towards Barangaroo. And a lot of it is to do with how they have to report to the Australian Tax Office. So unless you're running a massive, massive corporation, you probably don't need to invest in the office market because of the volatility of basically straightforward office suites inside a building. And when you think about the cost to run a building, the lifts, the maintenance, the fire, the cladding, you name it, it's an expensive beast. And so because today a lot of digital work is done through effectively people now working from home, the footprint of how much office is needed has diminished. And today the vacancy rate in the office market is pretty high. COVID really changed the dynamic of spatial change inside the office market. Now, there are other commercial considerations that we should consider. There is retail. Now, retail, again, is generally a marketplace which has a level of volatility to it. You know, today, a lot of the times, the best retail is in shopping malls, and that is owned typically by big business, Westfield. But certainly COVID redistributed with it the idea that we now shop quite local. So quite often you'll find a booming local retail dynamic of cafes and shops inside of the right local suburb. And the rents on that retail can be very, very good because today a lot of people are now shopping local. They're going to their local coffee shop, not the one in the CBD. And so the right retail can certainly dividend very, very well. But again, I think there's potentially better commercial properties in the marketplace to consider. And of course, beyond retail, there is special purpose. Now, special purpose is a purpose which the society needs the commercial to function. Now, a classic example is a petrol station. Now, if you've ever looked at the yields on a petrol station, they're amazing. They are next level. Like, the returns are incredible. The risk is high because obviously we are going into more of an electric car market than a petrol car market. Today, though, you can get a pretty spectacular return on a petrol station. Now, I've looked into it. I've thought about pulling the trigger and owning myself a petrol station with a tenant such as Caltex or BP. But I've chickened out. And the reason I've chickened out is I am not sure of the future of petrol stations. I don't know what will happen with electric cars. I just simply don't know the answer. And so I can't sort of bring myself to pull the trigger, but the returns are next level. So we've got office, we've got retail, we've got special purpose, and then commercial can also be a conversation around land, a commercial land. And, quite often large scale families, multi-generational wealth own land that is deemed commercial, but they are also holding it from a purpose of rezoning it. And again, that type of real estate is in the multi-millions, and you get some, you obviously see it on the news every now and then, some large-scale rezonings occurring on the right land use. And you also see, quite often neighbors teaming up together when a local government plan changes, because all of a sudden the higher and better use is not one house, it's 50 apartments. The same can be said for real commercial land out in the outer corridors, growth corridors. It can be large parcels of cow paddocks which need to be held until the land use changes. And I know families that have sat on land costing them $1 million a year, knowing that it's going to take them 20, 30 years to rezone those precincts. And of course, they will be in the holding costs for $20, $30 million, and eventually a rezoning will come through and they'll get obviously a massive jackpot. Now, the other type of use, which I think is very favorable at the moment, is really that commercial property which has industrial use. And if we think about how logistics works today, there is just so much going on when it comes to commercial warehousing and industrial. Why? Because today a lot of people don't even use retail shops to buy their goods. They will get it delivered. And because things are constantly being delivered, the amount of commercial warehousing and or industrial space needed in society has gone up. And you think about sort of the current state of affairs, people tend to work from home, they shop from home. And so this has put in a bit of a dampener on the wrong retail and the wrong office because people don't have to move as much. This has created a bit of a dampener on just how often we fill up our cars on things like special use. But what has been the winner has been, without question, warehousing and industrial real estate, commercial warehousing and industrial real estate. So recently I bought a commercial warehouse to invest in. And how that kind of works, by the way, is that it's a mixed use. You can use it as your own office, or you can use it as a warehouse, and or both. Now, very similar to a mixed use, such as using a property as an Airbnb, having a mixed use where you can offer multiple versions of tenancy, whether it be a warehouse, or whether it be a commercial office, is very, very smart, because it opens the door to just the amount of people who would want to rent those type of properties. And today in Australia, there's just so many people and so many businesses that want the right office, the right parking, and the right sort of warehousing to run their businesses. And there really isn't the amount of product out there that you would be able to put your foot in the right location. Of course, the right location is paramount, but the right mixed use, commercial warehousing is pretty solid. And typically what you'll find is an office upstairs and a warehouse downstairs in a tenancy like that, in a premises like that. Not to be construed as the office market inside of a CBD mid-rise tower, which again, from a strata perspective, is just a bad investment. You can't add value to the real estate, and really you're just lumbered with basically ongoing repairs and maintenance and fire costs, even though you can pass a lot of that on to the tenant market typically. because there's a lack of tenants, you as the proprietor are dealing with all of those problems. Conversely, the mixed-use office warehouse today and larger industrial premises are in extreme demand. And the yields on them and the growth on them is very, very good. The risk profile inside of commercial is probably one of the lower risk profiles compared to office, owning a petrol station, retail, or owning land that's going to take 20 years to be rezoned. The right mixed-use warehousing sits in a low-risk spectrum on that portfolio theory. And then if you apply it to the portfolio theory I'm talking about, how to build a modern portfolio, the right PP, principal place of residence, middle tier all-weather investments, the right trophy asset, that really scarce blue chip asset, the right Airbnb property in your portfolio, the right joint ventures you're involved in. If we added in the right commercial warehousing strategy, we can do very, very well. Now, I've just recently bought a commercial warehouse up in the Gold Coast, and the rent on it is fantastic. It's yielding very, very well. And as such, I think it's a great move. Now, would I buy that property if I just was starting out? No, I wouldn't. But as you build your portfolio, you start to require different assets. And again, I would say this is a really an asset like I just bought is a very good fifth property, not a very good first property. And I'll sort of explain how that kind of works when it comes to, the next steps of this conversation. Now, commercial property is all about its net income. The beautiful thing about commercial property, unlike residential property, is what I would refer to as a triple net lease. Now, when you get a tenant, you effectively are usually entering a very long lease term with that tenant. It's usually a 3 to 5 year lease with a further 3 to 5 year option. So you could effectively be entering a 10-year lease arrangement with a tenant. And as such, the leases are typically done by your lawyer with their lawyer. And in the lease, there is a section where the cost to look after the property is passed on to the tenant. So the tenant not only pays rent to you, but they are typically asked to pay the outgoings, insurance, strata costs, land tax, repairs and maintenance to the property. So effectively, you have very low outgoings, if at all any outgoings. Now, if you buy the right commercial property and it's modern, you're going to get depreciation. And effectively, what happens is you end up looking at the pie of who pays to own the real estate. You've typically in a pie, you've got the tenant, the taxman, and you. With the right commercial strategy and the right property, you're not paying anything. So it's the taxman and the tenant paying every single cent every single week to own the real estate. And of course, if you have the right yield, you actually can end up in a place where you're positive cash flow on the property. In other words, you're getting more rent than it even costs you to have a mortgage on the property. And so the right lease, a triple net lease, is the normal weekly rent, the things like insurances, land tax, and outgoings. And so all of that links to the fact that you're going to end up positive cash flow. And again, depending on how you gear the property, with a 20% deposit or a 30% deposit, will have a dynamic flow onto how much cash flow you're pulling out of the real estate. Now, quite often when we think about Australia, we don't really realize that Australia is made up of small businesses. It's really what Australia is. There are not that many big companies in Australia. It really is a marketplace where people go to work at all sorts of businesses below typically 20 people. Now, to give you an idea, the amount of sole traders out in the marketplace is circa 1.5 million. Micro companies, 1 to 4 people, is around 611,000, basically, companies. And then small companies of 5 to 19 people is around 212,000 companies. And so quite often in commercial, you're dealing with either sole traders, micro companies or small companies, or up to medium-sized companies where there's sort of 20 to sort of 40, 50 kind of people. And again, obviously, why companies rent properties and quite often don't own real estate themselves is just the flexibility around leasing. Now, companies might have a growth strategy behind them, a 10-year growth strategy, and for the first 5 years of that growth strategy, really they only need 10 or 15 people. And so they will rent a property which really lines up to that sort of mathematical equation. And quite often you see this a lot with commercial properties and commercial tenants. They might get fast rates of growth and they will outgrow the tenancy quicker than they expect over that 5-year period. In other words, year 3 or 4, they're having to look at alternative places to go, pay out their lease for the 5-year period, and effectively go and find other premises. So why businesses rent is quite often the flexibility around renting itself, because business is a difficult sport. You can bite off more than you can chew at times. And again, the problem with real estate is if your real estate size and space doesn't line up to your business model, you have less flexibility about how you can run your business. Now, again, this is why quite often businesses will simply rent. They will rent for a long time and they will build in that value into your lease. Now, in commercial property, the lease is worth a lot, and that really impacts what the value of the real estate is worth. In real estate, it's quite often common to have 3 versions of valuation. You've got direct comparison, which is effectively used in residential real estate. There's a house on this street, there's a house on that street. They both are very similar. They're not far apart. They're both recently sold. That is like for like, direct comparison. There's also summation. The cost to build something is also a way to value real estate. And then there's the capitalization rate, which is effectively what the rent is worth, actually creates a worth of what the property is worth from a value perspective. Now, the more weight a lease has, the more valuable the asset is worth. To give you an example, if you look at a commercial property online and the tenant is Betty's Cupcakes and she's got 1 year left on her lease, that real estate is probably not going to be at its highest value point. It may mean it's a good buy because you could buy the real estate, see out Betty's Cupcakes, maybe renovate the property and attract a much more longer term tenancy of 5 plus 5 plus 5 plus 5. Some leases will have 4 options to renew. They will be 20-year leases. And again, if you think about anchor tenants such as like a Coles or a Woolworths, when they rent a property, they're not renting it for 3 years. They're renting it for a 5 by 5 by 5 by 5 year lease term, which is 20 years. And when you've got a 20-year lease with Coles at a certain rate, which goes up every single year to the marketplace, that is very valuable because you've got a surety of income. With Betty's Cupcakes, you have less assurity of income. So, of course, that means the value of the asset is less. And, of course, in real estate, like any real estate investment, like resi, commercial has A, B, C, D grade variables to it. And the right commercial property is going to command with it a decent rate of rent. Now, to give you an example, when I bought the property I purchased commercially, a commercial warehouse, there's an examples nearby to where I've bought where properties rent for up to $400 per square meter. So every meter you get a rental return of $400. Now, I paid around $300 for my property per meter in rent, in value, because that's what you could get in rent. The upside for me is over the period of time, 5 years, 10 years, that square meter rate will rise. And it rises as part of the lease, but also due to market forces. Now, typically built into commercial leasing is a instant CPI change. So every year there is a CPI movement on the rent. The rent goes up. So typically it goes up with inflation, or in some instances, you can gear rents to grow above inflation. It could be put into the lease term, 10% above inflation or 20% above inflation. So what happens is commercially, as your tenancy gets older, you're typically pushing rents up, and that also drags the value of the real estate up. Now, the real estate I bought was circa $1,050,000 at $300 a meter. If it was $400 a meter, like the real estate, which was in a different spot, but the same city, not too far away, 5 kilometers away, I would have been paying about $1.25 million for the real estate. So we can see the real estate growth is built into the lease. It's built into future square meter rates. Now, again, no one has a crystal ball as to what's going on, but what I can tell you in Australia is there is a lot of small businesses that need the right home. And today, that idea of, commercial warehousing is probably one of the better ones in the marketplace to consider across your modern portfolio theory. Now, when you borrow money for a commercial property, it's typically a little bit more than a residential property. Typically, the risk is in the rate of interest. Interesting enough, at the time of recording now, the interest rate for the right commercial property is actually quite low. It's actually quite comparable to the residential marketplace. Really, probably that's a vote of confidence from lenders and banks that the right commercial property ticks a lot of boxes in there. Well, they don't see an oversupply in the marketplace there, and they see future demand for the right property. So certainly when I borrowed money, it wasn't much more than 6.5%, which I think is a pretty good rate. The other thing that will, obviously determine the rate you pay is the LVR. Now, you're not going to be able to borrow at 90% when you buy a commercial property. It's just not how it works. Typically, the loan to value ratio on commercial is anywhere from 60 to 80%. And again, you just need to factor in, if you're going to borrow at 70%, you're going to need 30% equity or cash to pick up the asset and buy it. Hence why I think you've got to quite often build wealth elsewhere in residential before you deploy that amount of capital into a commercial property. And you've also got to weigh up, is it the right use of your capital? You know, if you had, 30% to deploy into a real estate, could that actually buy you two other residential properties, i.e. 15% going into one and 15% going into another? But commercial just has better yields. It has better yields, cash flow. And again, the right cash flow strategy in the right structure, the right positive cash flow strategy in the right structure can quite often mean that from a lending perspective, it doesn't influence your serviceability. So again, you might be tapped out from a servicing point of view inside of residential, but that's where the beauty of commercial allows you to keep going. You can set up the right company trust structure. And of course, because the asset is positive cash flow, it pays for itself. You can acquire the asset. Now, again, sometimes you acquire assets without tenants in place, and this is where the nuance of commercial property dealings needs to be considered against behavioral finance. If you're going to wig out because, your toilet's leaking in your property and your property manager's one day late to fix the problem, you're probably not going to like commercial real estate, because typically if you buy a property vacant possession in commercial, you may have to factor in about 3 months to find a tenant. And when you find that tenant, you may have to factor in doing a startup deal with them, because when tenants move into a property, quite often they're asking for a rent-free period because they're moving out of another property, and because they're a business, they've only got so much cash flow. So typically, if you're buying a property, a get-started property without a tenant, you may have to factor in up to 6 month vacancy cover to get your occupancy up to eventually take the property to a point where you're into a 5 to 10 year lease. And that's just the nuance of it. So imagine, you buy a property and you've got to fork out $20 or $30 or $40,000 to find your first tenant. That's just part of the puzzle. And I liken that to just really part of the purchasing costs. The reality is that's the game. It's a different game of real estate. And the beautiful thing about it, though, is when you get a tenant in place, you can be locked in for quite a long time with that tenant and get yourself in a position where that tenant is covering all of your costs. The other thing you need to consider around commercial property is it has GST. So you want to be able to buy it with an ABN, because the price will be plus GST. And if you have an ABN, you obviously can work out ways to get that GST back. So you pay it out, but then you get it back. It is part of a going concern. And so, again, you want the right structures to be in place to borrow the money, to buy the real estate, to have it positive cash flow, to pay out the GST, and to get the GST back as part of the process of buying the real estate. So it can be a little bit capital intensive, but again, if you've got a lot of capital to deploy, rich people get really rich out of commercial real estate. Now, of course, there is commercial real estate which you can add value to. There is commercial real estate you can add value by renovating it. There is commercial real estate freehold real estate where you can add value to it by doing a development application and trying to turn commercial into residential. And of course, there's real estate, which I've just described, which is mixed use. The idea that you can use it one way or an alternative way. And I think for commercial, that's a really nice place to be. And that's why I personally chose commercial warehousing, because it can be used as both warehousing and commercial office. There's two uses. And in that space, there's around sort of 12% of businesses currently in Australia that sort of need that type of space. So I see a lot of growth potential in it. But that's a little taste of modern portfolio theory and commercial real estate. I'll leave it there, and we'll talk soon about more properties and ways to invest. Thanks for your time. Thanks for tuning in to the Urban Property Investor. If you enjoyed the episode, make sure to subscribe on your favorite podcast platform or YouTube so you never miss an episode. I'd love for you to rate the show and share it with your family and friends. Let's spread the word about property investing. Stay connected between episodes on Facebook, Instagram, and LinkedIn. And check out the rest of our podcast network at positivementor.com.au. And if you're serious about growing your property portfolio, don't miss our complimentary Property Investor Nights. Register now via the link in the show notes. See you next time.